Hello everyone, this is Brown's Wealth Management Watchtower. I am committed to building a visionary watchtower for you so that you can identify your direction and move forward steadily in a complex and changing investment environment. In today's world, where inflation and deflation coexist, how to ensure that your assets do not shrink is the most critical thing at present. This not only concerns your own future, but also the future of your family. Personal financial planning and wealth management are important means to ensure personal economic security and achieve financial goals. In this video, I will share some strategies on how to effectively carry out personal financial planning and wealth management to help you build a stable financial future. Firstly, you need to clarify your financial goals. In the current economic environment, how can ordinary people plan their financial goals? Before starting any financial plan, you need to clarify your financial goals. This may include short-term goals, such as reserving emergency funds or paying for upcoming expenses, and long-term goals, such as saving for retirement or saving for children's education. Once the goals are determined, corresponding strategies can be developed to achieve them. In the current economic environment, ordinary people need to consider the following key aspects when planning financial goals. You need to clarify your financial goals. These goals may include buying a house, retirement, educating children, traveling, etc. After determining the goals, you can set a time frame and required funds for each goal. Before planning financial goals, ensure that you have sufficient emergency reserves to cope with unexpected events such as unemployment, medical expenses, etc. It is usually recommended to reserve 3 to 6 months of living expenses. In terms of debt management, evaluate your debt situation, develop a repayment plan, and try to avoid high-interest debt as much as possible. Reasonably utilize credit cards and loans to ensure that liabilities are within a controllable range. Savings and investments require developing a savings and investment plan based on your financial goals and risk tolerance. It is possible to consider diversifying funds into different asset classes such as stocks, bonds, and funds to achieve steady growth of assets. In terms of insurance planning, purchase appropriate insurance such as life insurance, health insurance, accident insurance, etc. to reduce the impact of unexpected events on financial conditions. Secondly, it is necessary to regularly review your financial situation and investment portfolio and make adjustments based on market changes and personal needs. At the same time, pay attention to changes in tax policies and arrange tax planning reasonably. It is also necessary to increase sources of income and, where possible, seek ways to increase income, such as part-time jobs, investment, and wealth management. Diversified sources of income can help improve financial security. Learning and improvement are also important, constantly learning investment and financial knowledge to enhance one's financial literacy. Understand basic investment principles and risk management methods in order to better plan financial goals. Through the above measures, ordinary people can better plan their financial goals in the current economic environment, achieve stable asset growth and financial security. Secondly, establish a budget and expenditure plan. Understanding your income and expenses is the foundation of financial planning. By creating a budget, you can better understand your financial situation and determine the funds available for investment and savings. Meanwhile, a reasonable spending plan can help you avoid unnecessary expenses, thus leaving more funds for future financial goals. To determine your source of income, it is important to understand your monthly income, including salary, bonuses, and other sources of income. Ensure that your budget is based on reliable income data. List fixed expenses, including monthly expenses such as rent, utilities, insurance, etc. These expenses usually do not change, making them easy to predict. At the same time, it is necessary to plan for variable expenses, dividing other expenses into essential and non-essential items. Necessities include food and transportation expenses, while non-necessities include entertainment and shopping. Set reasonable budgets for these two types of expenses. To set savings and investment goals, set aside a portion of the budget for savings and investment. This will help you achieve long-term financial goals such as buying a house, retirement, etc. Monitor and adjust your budget, regularly check your spending situation, and ensure that you do not exceed your budget. If necessary, adjust the budget to adapt to changes in life or achieve specific goals. To learn how to use tools for assistance, everyone should have accounting habits and make full use of budget software or applications to track your expenses and income. These tools can help you better manage your funds and discover potential space savings. In today's economic environment, it is important to avoid excessive consumption, resist negative temptations, and avoid unnecessary shopping and impulsive spending. Learn to distinguish between needs and desires in order to make wise consumption decisions within the budget. Finally, emergency reserves are essential. To cope with unexpected events, I usually recommend setting up an emergency reserve fund equivalent to 3 to 6 months of living expenses. All of the above has been achieved, allowing you to better manage your personal finances, ensure a balance between income and expenses, and lay the foundation for achieving long-term financial goals. Once again, we need to establish an emergency fund. What is an emergency fund? An emergency fund is an important component of personal finance. It can help deal with unexpected events such as unemployment, illness, or other unforeseeable expenses without the need for investment or debt. As I suggested above, it is recommended to save at least 3 to 6 months of living expenses as an emergency fund. To evaluate your monthly expenses, review your bank statements and credit card statements from the past few months and calculate your average monthly expenses. This will help you understand how much funds are needed to sustain your livelihood in emergency situations. Calculate the target amount for the emergency fund, and it is generally recommended that the total amount of the emergency fund be 3 to 6 times your monthly expenditure. For example, if your monthly expenditure is 3,000 yuan, then your emergency fund target should be between 900 and 18,000 yuan. This amount can be adjusted according to individual circumstances, such as family responsibilities, career stability, and other factors. To open a dedicated savings account and ensure that emergency funds are not eroded by daily expenses, it is best to open a dedicated savings account at the bank, separate from your other accounts. It is also necessary to make regular deposits and develop a plan to deposit a certain percentage of income into an emergency fund account every month. It can be a part of the salary or an additional income. Reduce non-essential expenses, examine your spending habits, see if there are any areas that can be reduced, and use the saved money for emergency funds. Investing in potential fund unicorns. Although the primary goals of emergency funds are safety and liquidity, you can also consider investing a portion of them in low-risk financial products such as money market funds or short-term bond funds to earn higher interest returns than traditional savings accounts. Finally, it is important to regularly evaluate and adjust the size of the emergency fund to ensure that it still meets your needs, as your living conditions may change over time. If necessary, adjust the deposit limit or target total amount. Don't forget to maintain discipline. Emergency funds are established for truly urgent situations and should be avoided from being used for non-essential expenses. Through the above, you can establish a solid financial safety net and be prepared for any emergency situations that may arise. Debt management is also essential. Debt is mainly divided into long-term debt and short-term debt. Long-term debt is typically used for capital expenditures, such as purchasing fixed assets. The characteristics of this type of debt are long maturity and relatively low interest rates, but long-term repayment pressure and possible interest rate risks need to be considered. Short-term debt is often used for emergency funds or seasonal funding needs. Short-term debt typically has higher interest rates but shorter repayment terms, making it suitable for anticipated funding gaps in the short term. Evaluate one's debt level and debt-paying ability through financial ratio analysis, such as debt ratio and interest coverage ratio. Establish good cooperative relationships with banks and other financial institutions and strive for more favorable debt financing conditions, such as low interest rates and flexible repayment methods. This not only contributes to stable operation in the short term, but also provides a solid financial foundation for long-term development. Make good tax planning. Understand tax rates and categories. Familiarize yourself with the tax laws of your country or region, including income tax, capital gains tax, inheritance tax, and applicable tax rates. If possible, distribute income among different family members, especially those at lower tax rates. By donating to qualified charitable organizations to offset taxable income, while also contributing to social welfare causes. In short, tax planning should be a continuous process, and with changes in tax laws and personal circumstances, your planning also needs to be adjusted accordingly. Choose a good insurance plan. Insurance planning is an indispensable part of personal financial planning, which can provide economic security for individuals and families in the face of risk events. There are various types of insurance products on the market, such as life insurance, medical insurance, accident insurance, etc. Choosing products that are suitable for one's insurance goals is crucial. When choosing insurance products, it is important to compare the market and seek advice from professionals to understand the reputation and stability of insurance companies. Reasonably planned premium expenditures. It is generally recommended to control premiums between 10% and 20% of annual income. Before purchasing any insurance product, it is important to fully understand the contents and precautions of the insurance contract to avoid future claims difficulties. There are different insurance needs and planning strategies based on different life stages, such as single period, nest building period, full nest period, and empty nest period. Make retirement plans in advance. Retirement planning is an essential part of personal finance, and considering the longevity expectations of modern life, early retirement planning is crucial. Firstly, you need to determine your retirement goals. This includes when you wish to retire, your lifestyle after retirement, and the necessary funds. Calculate the funds you need after retirement based on your retirement goals. This includes living expenses, healthcare costs, travel expenses, etc. Develop a savings plan based on the required retirement funds. This includes fixed deposits, investments in stocks, bonds, or other investment instruments. To achieve your retirement goals, you need to invest and manage your finances. Choose investment tools and strategies that are suitable for you to achieve steady growth of assets. When investing and managing finances, it is important to avoid risks. This includes diversifying investments, avoiding high-risk investments, etc. Regularly evaluate your retirement plan and make adjustments based on market changes and personal circumstances. Also, if you are concerned about your living expenses after retirement, you can consider purchasing pension insurance. This can provide you with some protection. If you are unsure how to plan for retirement, you can seek help from professionals. They can provide you with professional advice and guidance. The most important thing is to maintain a healthy lifestyle, which can help reduce healthcare costs after retirement. That's all for this issue. If you have any questions, you can communicate in the comments section or follow me with your fingers to provide different perspectives on investment and financial planning, making your life more comfortable. See you in the next issue.